Hi, I'm Liam, welcome to the channel, and today we're dealing with the problem of what to do when stocks go down. Let's get into it. So let's set the scene. It's 2021 and anything you put your money on seems to go up no matter what you do. You can sit back, chill and think you're the best investor in the world because lo and behold, you're in the green. But when it goes red, what do you do then? Well, beyond panicking, we all go back to that famous saying, be greedy when others are fearful and be fearful when others are greedy. It's easy, simple, right? No, extremely hard to do. There's two ways of looking at things here. Either you're going to get the bargain of the century because the stocks that you want to get more of are now cheaper, effectively on sale, or you start to question your conviction. If you're questioning your conviction, you're worried about the exposure you have to certain stocks because they're on the way down and you're not sure where they're going to stop or why you even invested in them, then the problem is before you actually bought that stock, you should have done research. You should have made a valuation of the company, check the PE ratio of the company, see the fundamentals of the company, what you like about them, where you think they're going to be in 3, 4, 5, 10 years time. If you haven't done that, chances are you've YOLO'd in when the stock's going up. You want to get in on the action because it's going up, it's going to go up forever, right? Wrong. You've got suckered in and it's easy to do. We've all been there. But the truth is, the money in stocks is made when you buy them and at the point you buy them. So with that being said, the stock price is down, it's time to buy, right? Well, hang on. We've got to ask ourselves a few questions first. Namely, how long do you plan on investing, or when would you like to get your money out of these stocks? If it's short term, you need the money quickly, chances are you might want to cut your losses. Again, this isn't financial advice, but if you need that money, you can't risk it going any lower than it currently is. It might be time to cut your losses, get it out, and think about reinvesting next time for a longer period of time. If the answer is medium to long term, then there's a lot more options available to you, and we have to ask ourselves some more questions. The main one is, why do we think the market is going down? Now for this, we're going to have to do a bit of research. Get on the internet, have a little look, and see what we think is going on. The first thing to really recognise is it the whole market? Is it not just your stock, but does it seem to be every single stock or most of the stocks on the stock market? If that's the case, then it's a complete market downturn, and this might not be that big a case to worry. Then we look at our individual sector. Is the sector you're in on a downturn, or is it just your stock? So for example, if you're invested in Tesla, is the whole EV market going down, or is it just Tesla? If we find out it's not the whole EV market, it is just our stock Tesla that's going down, then we need to research into the company itself. Have we missed something? Is there some news? Is this fundamentals that are changing? Perhaps they've missed their earnings. What is going on? Like the chip shortage we had, that would affect the Tesla price. We knew that would happen. It did go down, but subsequently it bounced back up again. These are the things we need to understand, and once we understand them, we can act accordingly. Hopefully you've managed to understand the reason why it's going down, or at least some basic understanding of what's going on in the market currently. Now this moment is usually complete euphoria or complete fear, because at this point we know that the stock is on sale. Think of it like a car. If you went and buy a car and it's usually £10,000 and you go in the showroom and it's there for 8 and you were going to buy that car anyway, you're happy, you're over the moon, you've got a £2,000 discount. The same can be said for stocks, and it's when they're down and the possibility of them going down further that we really start to question why we bought it in the first place. And if that is the case, chances are you're going to want to change your position and get into something that you actually believe is going to go somewhere long term. Otherwise, you're over the moon. The stock you want, the one you believe is going to go somewhere long term, is now on sale and cheaper than it was the last time you bought it. And the name of the game with stocks is to accumulate as many as possible. And now you're going to be able to do that and get more for your money effectively. But hang on, what if the stock drops further? Should we wait and try and accumulate these extra shares at a cheaper price once it's really hit the bottom of the market? Well, let me tell you now, you may be able to time the market once or twice, perhaps, but chances are, like the rest of us, you will fail in doing so and you will miss the boat waiting around for that bottom. Your best bet is to make an educated guess at what you think the market's going to do from here on in. If you believe it's almost at the bottom, perhaps the pain is easing a little bit and you think it's going to be a ride upwards from here on in, buy the amount you originally wanted to buy in one go, hold and wait for time to pass. If you're still a bit fearful on the other hand and you think the market could experience some more pain, but you don't want to miss a really good sale on the stock that you love, then split your money up. Say you got £1,000 to invest, split it into, I don't know, 4 equal amounts, 250 quid. Buy 250 quid's worth today, wait and see what happens tomorrow. If it goes down again, perhaps you buy another 250 quid's worth. Then it might go up, ooh, 5% increase. Well, I don't really want to buy now. I'll wait out and see what happens. 2 days later, it's back down again. Right, I'll have another little bit of that, 250 quid. There we go, lovely. And this way, you can guarantee that you lock in a bit of that extra reduced rate, and you also have a bit of cash on the sidelines just in case it goes down further and you get it at an extra discount. Now, there's 2 things I really love about this. The first one, who doesn't love a sale? I love a sale. So if I bought a share a month ago for £100 and it was down 50%, I could buy another share for 50 quid. Or if I put £100 in, I would get 2 shares or 100% more than what I got last time for the same amount of money. Brilliant, love it. The other thing that really helps for me is that you're able to average down the average cost you've paid for those shares. So let me explain. If you bought a share last month for £100 and that stock went down 50%, today you buy another share, it's going to cost you £50 for the same amount of that company. But when you look at your portfolio, rather than being 50% down from a month ago, you've now averaged your cost per share to £75. You've met in the middle. One was £100, one was £50. If you average it out, it's 75 quid each you've paid. So now when you look at your portfolio, you're only 25% down. There's less to make up. It's great for psychology. It's a win-win situation. Now, the only time I would do nothing in this situation is if I didn't have any money or I'd run out of my buffer. So we should always have a buffer, which is a stockpile of cash sitting on the sidelines, ready to take advantage of situations like this where we can accumulate more of our favourite stocks at a cheaper price. Or perhaps you do nothing because you've learned from your research there's something causing this and you know it's going to last for 3 or 4 months and you expect the stock to continue going down until this is out the way. Well, in that case, maybe do nothing, but believe me, don't waste a red day. Just have little nibbles, little tiny nibbles. Every time there's a red day, just buy a little more. Just buy a little more, just buy a little more. You won't get the absolute lowest rock bottom price, but you also won't miss that sale. And that's the most important thing. If you're in this long term, then every time you buy at a reduced rate, in the long term, it's going to be profit for you. If it's short term, then I'm sorry, it might be time to get out. But really, what you do in trying to short term trade the stock market, we know how volatile it is. And if you needed that money short term, don't put it in the stock market. Only put money in the stock market you can afford to lose. It's as simple as that. If you've liked what you've seen here, please subscribe, like and comment, and I'll see you in the next one.